Your strategy looks strong. The metrics? Impressive. The equity curve? Sloping beautifully upward. What's not to like, right? Well, think twice. Because here's the uncomfortable truth. Your backtest might still be worthless. It might be luck. It might be randomness. And it might fool you, just like it does in life. In fact, if you skip proper validation, that beautiful backtest could cost you real money. That's why in this video, we'll cover 4 of the most common backtesting mistakes and how to avoid them. Stick around, because one of these mistakes could be hiding in your strategy right now. Mistake number 1, the out-of-sample illusion. Most traders do this. Split the data once, say, 70% for building the strategy and 30% for testing. Sounds reasonable. It's not. That single split is arbitrary. Your Sharpe ratio, drawdowns, and returns are now tied to one random point in time. Shift that split a few months in either direction, and your system looks totally different. You're not testing robustness, you're just testing luck. And when you use recent data as your test set, you're actually removing the most relevant info, right when markets are changing fast. How do you fix it? You can use walk-forward optimization because it's more robust than a single out-of-sample split. Or you can run Monte Carlo simulations to test randomness. But most importantly is to put the strategy in incubation, a live demo account, for months, ideally at least a year. Mistake number 2, ignoring transaction costs and slippage. If you didn't include transaction costs, slippage, or spreads, your backtest is fiction. Even a tiny cost of 0.01% per trade can wreck performance over time. And for high-frequency or volatile strategies, the damage is even worse. At quantifiedstrategies.com, we stick to super liquid assets like QQQ, SPY, and GLD because they're less prone to slippage. And based on our experience, a 0.03% cost per trade is a good baseline for realistic testing. The fix: add realistic costs, not arbitrary ones. Costs differ across assets and strategy types. For example, breakout strategies often have higher slippage than mean reversion. Mistake number 3, trusting lucky results. Let's face it, backtests can lie. Especially if you tweak too many parameters, run dozens of variations. Keep hunting for the one strategy that looks great. Eventually, you'll find one that shines simply by pure chance. The more parameters you use, the more fragile your strategy becomes, and the more likely it will fail in real trading. Simplicity trumps complexity. The fix: use walk-forward testing. Run Monte Carlo simulations. Do sensitivity analysis on your parameters. Test your strategy across multiple time frames and market regimes. And yes, incubation again. Because live demo exposure is the ultimate reality check. Mistake number 4, ignoring the number of strategies you've tested. The more strategies you test, the more likely your best one is just the luckiest. Test 50 strategies on the same dataset, and some are bound to look amazing purely by randomness. This is called multiple testing bias. It's one of the biggest reasons a great strategy crashes the moment you go live. The fix: track how many strategies you've tested, and again, use walk-forward, Monte Carlo, and incubation. Yes, we're repeating it, because it works. Backtesting isn't just about making the chart look good, it's about stress testing your ideas across randomness, costs, and real-world messiness. So the next time your strategy looks perfect, ask yourself, is it robust or just lucky? If you found this helpful, give it a like, subscribe to the channel, and check out the link in the description to our backtesting course, which includes one complete strategy to get you started.